Becoming a millionaire is simple if you invest in index funds consistently for the long term. In fact, building wealth and becoming a millionaire doesn't have to be complicated at all. The most important things to remember in building wealth and becoming a millionaire are consistent contributions to a diversified, low-cost fund over a long period of time. And this is best achieved by investing in an index fund. Hey, what's going on, everyone? My name is Trey, and welcome to Let's Talk Finances, where on this channel, we specifically dedicate our time in helping you, the investor, invest your way into millionaire status by way of the index fund. So if that's something you're interested in, go ahead and subscribe. What exactly is an index fund? An index fund is simply a mutual fund that seeks to track and mimic a particular index. Now, the S&P 500 is actually an index, as a matter of fact, one of the most popular indexes, but there are plenty to choose from, to include those indexes that have small, mid, large, even international exposure in terms of funds. To help this make a little bit more sense to you, you go into a grocery store because you're shopping for some fruits and vegetables, bananas, apples, oranges, cucumbers, and all of those fruits and vegetables cost you a specific dollar amount individually. You go into your favorite grocery store and they're all of a sudden doing a sale. All of your favorite fruits and vegetables, instead of buying them one by one, they include it in one basket. So in one basket, you can have all of your favorite fruits and vegetables for a lower price. That's the thought process that you should be looking at when we're talking about index funds. So instead of investing in these companies on their own, you can purchase a basket of all of these stocks, and instead of owning 1, 2, or even 10, you can own hundreds or even thousands by investing in, let's say, a total stock market index fund. So now that we have this covered, what is the difference between an index fund and a mutual fund? The simplest way to break this down is the differences between an actively managed fund and a passively managed fund. So a passively managed fund, which is a representation of an index fund, is one that is not managed by a particular individual. Therefore, the fees are much, much lower. Passively managed funds simply follows and seeks to mimic a particular index, and because of that, it's a lot less volatile and a lot less riskier. Whereas actively managed funds are those of which stock pickers consistently try to outperform the market. And because of this, you have to pay a particular individual to manage that fund for you. And because they're managing it for you, they can charge you a lot higher fee. In 2021 alone, studies have shown that only 20% of those actively managed funds actually beat the market. And in addition, those actively managed funds are way more expensive. So in terms of index funds, you have some that actually charge you zero. All right, some that charge you zero expense ratios, like Fidelity's zero index funds. Today in 2021, the market average for actively managed funds in terms of expense ratios are 1.25%. And that is a significant difference. So just remember, passively managed funds are index funds. Actively managed funds are mutual funds. But don't be confused. Index funds are actually a type of mutual fund. So what do some of the most popular and most successful investors actually say about the index fund? Warren Buffett, who is considered the most successful investor of our time, says to consistently invest in an S&P 500 index fund and don't look back. So much so that we actually have the Warren Buffett portfolio. And if you want more information on that, I went over it in this video here, so be sure to check that one out after this. John Bogle, who was actually the creator of the index fund through Vanguard, says, hey, listen, don't try to pick the needle in the haystack, just buy the entire haystack. Tony Robbins goes on to say that single stock or actively managed investments are much more riskier than an investor needs to be in terms of investing. Index funds is a fail-safe way to invest and eliminate the risk. So that begs the question, why should you be investing in index funds? Well, the number one answer that I can give you to that is simple. It's to become a millionaire, right? It's to make money, because that's what we all want to do. That is the reason that you're currently watching this video. That's the reasons to why I hope that you're actively researching funds, index funds, so that you can become a millionaire and pass that generational wealth onto your children and your children's children. In 2021, an S&P 500 index fund is yielding an 18.26% return. To date, as of 2021, the market average for returns in terms of index funds are about 11%. Let's say that you start investing, you put in $10,000, and then on top of that, you're investing $500 per month while you're getting a 10% return for 25 years. Due to compound interest, you would have nearly $790,000 at the end of those 25 years. However, if you stretch it a little bit further to 30 years, you'll have nearly $1.4 million. So the next question being, how much should I invest in index funds if I'm looking to start? So most financial advisors say that you should be investing somewhere between 10 to 15% of your monthly income. Now, on average, according to the median salary today in 2021, it would be about 12%, right? So that will bring you to about $400 to $500 per month. Now, for those of you who are like, oh man, $400, $500 a month is a lot of money. Listen, you've wasted more money on those Krispy Kreme donuts than you would have making a good, solid investment for your and your children's future. That takes us to the next question. So, which funds should I be investing in if I actually want to start investing in index funds today? And I'm glad that you asked that question. Now, one of the most popular portfolios would be the lazy portfolio. Why? Because it's simple, you don't have to do much, and it reaps you a lot of return. So that 3-fund portfolio is going to consist of a US stock, an international stock, and a bond stock, all right? And if you need a further example of which ones those actually are, a total stock market index fund like VTSAX, or an S&P 500 index fund like VFIAX. Then you add that with an international fund like VTIAX, and then a bond fund like VBTLX, and your portfolio is complete. It's simple, it's easy to manage, not complicated, and you can do this for the long term. If you want more information on what you should be putting in your portfolio and the different types of portfolios, I went over it in this video, so be sure to check that one out after this one. But listen guys, at the end of the day, it's your finances and you want to make the best decisions possible so all of your hard-earned money can work for you. And I know it can become a scary thing because you don't know who to trust, you don't know what to do, and you almost feel like you're gambling. But listen, I'm not being paid by Vanguard or Fidelity or Charles Schwab's. I don't get paid by any of them, all right? I simply started this channel because upon my investment journey, I realized that it gave me a lot of freedom in knowing that I was making the right decisions for myself and for my family, and I just wanted other individuals to feel the same way. So I'm making this video to tell all of you who are watching this, who are apprehensive and don't know what to do, go ahead and start investing in index funds. It's going to be something that you will not regret. In actuality, you're going to regret not doing it sooner. So go ahead and get started. There you have it, guys. How to become a millionaire through investing in index funds. I hope you've enjoyed this video. If you've had, please do not hesitate to hit the like button and don't forget to subscribe. And as always, I want to thank the men and women who have served and who continue to serve this country. I greatly appreciate you all. Until the next video, guys, let's talk finances then.